you better be prepared for complete chaos.
Chaos, that's what the crypto market is: chaotic, unpredictable, and thrilling. But amidst the chaos, there is a way not just to survive, but to thrive. In today's video, part of the Ultimate Beginner's Guide to Crypto series, I'm going to walk you through the essential principles every new crypto investor needs to master. Get ready, because these tips can make all the difference between a successful investment and a painful loss. Let's start with the most important rule in crypto. Never invest more than you can afford to lose. Imagine this: you're riding high on a bull market, your portfolio has doubled, and you think, this is it, I've hit the jackpot. But then one unexpected piece of news hits, the market crashes, and suddenly everything is gone. If you've put in money that you couldn't afford to lose, say your rent or emergency savings, that crash could be devastating. But if you've only invested money you're okay parting with, it's a different story. Sure, it stings, but your life doesn't get turned upside down. That's why the golden rule is simple: only invest what you can afford to lose. Now let's dive into crypto market cycles, because crypto operates in cycles: bull markets when prices rise and bear markets when prices fall. One of the major drivers of these cycles is the Bitcoin halving, which happens every 4 years. During a halving, the reward that miners receive for processing transactions is cut in half, reducing the supply of new Bitcoin. And this event typically kicks off a bull market where prices rise as demand outweighs supply. But after every bull run, there's always a bear market where prices can drop by 70% or more. So understanding these cycles will help you avoid buying at the top and panicking when prices drop. The last halving was just a few months back in April 2024, which could mean that we are just a few days or weeks away before a big rally upwards, or maybe we are already pumping by the time you are watching this video, so who knows. A critical part of successful investing is knowing when to take profits and having an exit strategy. Imagine you're watching your investment skyrocket only to see all your gains wiped out when the market turns. Don't let that happen. Here's a simple approach: set profit targets for yourself. Maybe sell 25% when your investment doubles, or take out your initial investment once you've reached a certain return. The key is to take profits along the way. You can also use stop losses to protect yourself from the downside. If the market drops to a certain point, you automatically sell, locking in profits or cutting losses. Remember, it's not about holding forever, it's about securing those gains. And if you want to dive deeper into profit-taking strategies, you can take a look at this video over here, where we walk you through everything you need to know about profit-taking. You've probably heard of the saying, money goes where attention flows. In crypto, that's more important than ever. Yes, fundamentals are the baseline. You want to invest in projects with strong technology, a solid team, real-world use cases, but strong fundamentals alone don't guarantee price increases, in crypto at least. Projects need attention, and attention follows market narratives. Usually topics that really do well are simple to understand for the broad majority. Maybe it's AI, DeFi, gaming, meme coins, whatever's hot at the moment is what attracts investment. When evaluating a project, ask 2 questions. First, are the fundamentals strong? And second, does it fit into a current or emerging narrative? If the project aligns with both, you're more likely to see real growth. Let's be real. FOMO, or fear of missing out, is a real killer in crypto. You see an influencer hyping a coin and suddenly everyone's talking about it, but by the time you hear about it, you're likely already too late. That's why staying emotionally detached is critical. Making investment decisions based on emotions, whether it's greed in a bull market or fear in a bear market, can lead to a disaster. The market is volatile, and if you're too emotionally involved, you'll make impulsive moves. First of all, have a plan, and then stick to your plan. Don't chase the hype, and always make decisions based on research and strategy. Remember, the best investors know how to keep their emotions in check. When you're starting out, it's tempting to go all in on one coin or a bunch of small, risky coins. But in crypto, balance is key. You want the majority of your portfolio in what we call blue chips, the most established cryptos like Bitcoin, Ethereum, and even Solana, but especially Bitcoin. I mean, What are we even doing here if you don't have any exposure to Bitcoin? Bitcoin is the holy grail. And if you want to know why, I have another video for you on this topic, so please check it out. Anyway, blue chips have been around the longest, have large market caps, and have proven themselves time and time again. By keeping a large portion of your investments in these safer bets, you offload a lot of risk. And with the remaining portion, let's say 10, 30%, that's where you can take on more speculative, higher risk projects. Here's one of the most important rules for new investors. Don't use leverage. Leverage is when you borrow money to make bigger investments, hoping to amplify your gains. But in crypto, it's a recipe for disaster. Crypto is already risky enough on its own. Adding leverage can turn a small loss into a huge one overnight. Greed can get the best of you, but trust me, the risks far outweigh the rewards. Stay away from leverage, especially when you're just starting out. Security should never be an afterthought in crypto. You've worked hard to build your investments, so don't leave them at risk. Leaving your crypto on an exchange long-term is like leaving cash in your glove compartment of your car. It's just not safe. Get yourself a hardware wallet like Ledger or Trezor. These store your crypto offline, which makes it nearly impossible to hack, and always keep your recovery phrase safe. If someone gets hold of that, they can drain your entire wallet. And if you want a recommendation, I've added a link to a hardware wallet that I personally use in the description down below. The crypto market moves fast, and staying informed is key. The good news is it doesn't have to be hard. You can sign up for channels like Cointelegraph or Watch a Guru on Telegram, and they'll send major news straight to your phone. No need to go to a website and read long articles for yourself. All you get are the headlines, and you can at least stay baseline informed on what's happening in crypto. When the market heats up, you need to be ready to move quickly. Staying informed could mean the difference between locking in gains or watching them disappear. Information is power, especially in crypto. Crypto's volatility is intimidating, but there are tools you can use to make smarter decisions. Indicators like moving averages, a relative strength index, RSI, and on-chain metrics give you a clearer picture on the market's mood. For example, moving averages help you spot trends. If the price crosses above or below a certain moving average, it could signal that the market is turning bullish or bearish. Many people look at the 200-day moving average, for example, and use this as a signal to tell them when to exit the market. Additionally, on-chain metrics like the number of active wallets or transaction volume show the health of the blockchain. Looking at data is key, so stay informed. And if you're not sure how to read those indicators yourself, follow people who do. Analysts like Rec Capital on Twitter or Bitcoin Strategy on YouTube are great resources. These principles are your foundation, but this is just one part of the If you found this video helpful, check out the other videos in this series where we cover everything from how to buy your first Bitcoin to understanding crypto wallets. And don't forget to hit that like button, subscribe, hit the notification bell, and keep following along as we continue our crypto journey. Thanks for watching, and I'll see you next time.